Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. Well, in this installment, we're going to talk about just a little bit of information that hopefully will be some level of encouragement for you. The main reason I put together the video is that, markets continue to be turbulent, up, down, sideways, zigging and zagging, and the geopolitical events around our world and economic news all tends to be pretty negative. And so it's during times like this that the patience game is critically important. And anything we can do to help us to be disciplined in the midst of uncertain capital markets is really a helpful resource for us. So I'm going to show you a couple of slides that are helpful, I think, to give us a bit of a vision that's lifted up a little bit above the current fray so we can focus back and say what are the best actions in the midst of market volatility and economic uncertainty. Now, if you're new to our channel, make sure that you hit the subscribe button. We're posting content all the time on various aspects of retirement income planning and various wealth planning topics. If you go to the show notes for this video, you'll find links to helpful free education resources. And if you're thinking about retirement and you'd like a second opinion, if you go to our website, on our homepage is a discussion on how you can get a complimentary retirement income plan and second opinion. Okay, let's take a look at some information that might be a little bit encouraging. Now, the slide that's in front of you on your screen is a slide that looks at the S&P 500 stock market index over an extended period of time. You can see the chart goes 1930, actually a little before 1930, and then we go all the way through to past 2010. Now, no, it's not right up to date in terms of our current 2023 data, but it's very instructive, I think. So it looks at the subsequent 5-year total return on the U.S. market post some pretty significant volatility in capital markets. So you can see in May 1932, the Great Depression. Following that, the U.S. stock market was up 367% over that 5-year time period. If we go to recession in July of 1982, following that recession, again, we had a 5-year recovery period totaling 267%. If we go to 1994, again, rising interest rates and Federal Reserve Board tightening, post-1994, we saw 251% gains in the U.S. market. And then in March 2009, post-Great Recession, the next 5 years, the market was up 178%. Okay, and that's a trend line. Now, why does that happen? Let me show you another chart that is somewhat illustrative of the reasons why we see that kind of uptick post calamitous events in the economy. So this chart is probably a chart you've seen in previous presentations I've done, and all it does is looks at 1981 through to 2022, and the red bars here to the negative are bear market cycles or down markets, and the blue bars here are up markets. Now, generally speaking, what you see is that on average, the market's up more than it's down. So I've always used in previous presentations, on average, about 75% of the time, capital markets are up, 25% of the time, they're down. The down periods are not fun, but the reality is there are more up markets, and the upside usually is much greater than the downside we go through. And this is why when you see these downside years in red, you see multi-year recovery. So usually the way the markets work is you'll digest a downside, you'll digest the impact of slow economic growth or recession, and then as the market comes out of that, everything's cyclical, you begin to see an expansion of the economy, improved corporate earnings, and of course higher share prices. So we would expect that would happen again. The problem is we don't know when the timing of that is going to happen. That means that we're in this game of patience. That's the most difficult part of being successful with our growth portfolios, but it's a very important lesson we need to always reinforce and remind ourselves of. And the reason why is this chart. So again, you may have seen this from previous presentations. This is the a chart that looks from 1992 to 2011. This is Canadian data, and this is data pulled together by the Investment Funds Institute of Canada, and they took a look at the average stock fund return by all stock funds available to Canadian investors at that time between 92 and 2011. The average was 8.2% compounded returns. And then they were able to determine through the data and cash flow in and out of each of the fund investment complexes. And what they found was the actual investor returns were 3.5% per year. The study referred to this as the investor behavior penalty. And again, there's a lot of behaviors that get in the way of being successful with our growth portfolios. But one is the whole timing issue. So typically what happens is when there's a slowdown in the economy, if the market does go through a retraction in value, and as we're waiting, the longer we go through this waiting period, the higher the likelihood that investors will begin to bail out of frustration, trying to seek other alternatives that ultimately will hurt their medium to long-term investment performance. So it's an important chart to keep in mind. Anyway, a little bit of positive news, at least from a standpoint of things that we need to remind ourselves about when it comes to markets that are sideways down, no real solid momentum, lots of negative news. Hope that's helpful for you. Now, again, in the show notes, there are resources, complimentary free resources you can tap into, so make sure you take a look at that. And again, if you're new to our channel, make sure you hit subscribe so you don't miss future content. And if you're looking for a second opinion on your retirement plan, then make sure you go to our homepage where you can find out how you can get a complimentary retirement planning analysis. You take care. Wishing you all the best in your wealth planning and overall retirement planning journey.